Thank you everybody for joining. I know some of you joined on Friday as well. Remember we had that technical issue, unfortunately. But anyway, all looks good now. We've had some interesting economic data out for sure. I'm just, bear with me one moment. I'm going to move all this. Hang on. Because I want to really just show you my charts. But there was some Eurozone retail sales data out, which was slightly odd. Better than expected on the month, worse than expected year on year. That can sometimes happen because of revisions, etc., and seasonal adjustments. So do watch out for that. Overall, that is, yeah, it's all right. It's probably, people are going to probably look at the monthly, but actually that data, because it's quite difficult to read, it's probably not going to have too much of an impact on the euro today, and tends to be that one data point doesn't. So let's get straight in on this. Bear with me one moment. And let's start looking. I wanted to kind of, obviously, what we saw yesterday was there was a rise in bond yields. Now let's just look quickly at euro. I'm going to look at the daily charts. So obviously, big sell-off from 137, and that really did tie in with this. Let me just show you. I'm just pulling it up now. That sell-off in euro just in the last 2 days really did show up with, or really did correspond with this move higher in Spanish bond yields. This is the 10-year yield. Obviously, when you look at it from a year's perspective, it doesn't look like it's that high. But you know, it really has moved very, very strongly. What we saw this morning was a shoot higher towards 5.5%. That did cause euro to fall. Remember, someone's just questioned about audio. I think you probably need to sort out your own audio, actually. I believe my audio is working. FX Street, if you could just sort that out with that Stefan's audio. I think he may need to just adjust his own set. Basically, what we've seen is markets yet again kind of going into that risk aversion mode. And that was really led by what was going on in Europe, what was going on with Eurozone peripheral bond yields. When that happens, what we've seen in the past is that peripheral bond yields, Eurozone sovereign concerns, can really have an impact on all markets, including markets the other side of the Atlantic, and we really did see that yesterday. So we did see, US stock markets really get hit by the euro, and really the epicenter was the European issue. It was issues with political risk in Spain, which wasn't expected, political risk in Italy, which kind of is expected, and such like. So what we just looking at euro here, what we've really done though, however, is actually put in a little bit of a short-term bullish pattern. So here is a bit of a bullish harami pattern, which suggests that below 134.50, so around about 134.45, could be a temporary low now in euro dollar. This is when you get a long red candle, which is a down candle, followed by a very short-bodied up-day candle. So it's not exactly perfect, this pattern, but it does suggest that maybe bullish or negative sentiment is starting to wane, and we could potentially just have a bit of a short-term bottom in place. So this kind of, I suppose, 134.40 would be that level. We've since then had like a nice push higher. 135.50 obviously is near-term resistance. Now, what are the key things that can push this across? So we've seen a strong move higher. Let's just change time frame quickly. A very strong push higher of late, for recent months. Having a pullback at this stage is completely normal. It doesn't, as you can see from a longer term time frame, it doesn't look like we've changed direction in any way, shape or form. But a lot of what has helped drive the euro higher, drive stocks higher, has been stabilisation in the currency bloc. And what we saw yesterday is that there's a bit of concern that things aren't that stable. Now, who can stabilise the eurozone going forward? The ECB. What does that mean? That means this ECB this week's ECB meeting on Thursday is going to be absolutely vital. Now, I'm holding a pre-ECB webinar that will take place on Thursday. We've also got a research note coming out, which you can find on the forex.com website on tomorrow evening. So please do take a read of that just to give our preview. I'm not going to give it all away now, but basically we do think that that's going to be the next major driver of the euro, and until then we could kind of range trade in. Now, obviously, this 137 level had been the highest level for multiple months. It suggested that, you know, things were good. However, since then, that was some people argued that was irrational exuberance. We would say that we may get back up to maybe this kind of double bottom here, 136, which is now very, very good, which is now short-term resistance. We may get back there in the kind of next couple of days, but we think it's going to be very hard to recoup all of those 137 losses. Add to that, you've got to also remember that Spanish bond yields, you've got to keep an eye on them, because the euro is really moving inversely to Spanish bond yields. So Spanish bond yields are rising on the back of rising stress in Spain. The euro has been falling. So a recovery in Spanish bond yields, recovery in the euro, that type of thing. So recovery in Spanish bond yields, by the way, means that they fall, not that they rise. I'm sure you've all got used to that. Now, the other thing I wanted to show you, the other big mover, was the pound, because this is where... this is the hourly chart. Let's take a look at the daily chart. This really is a bearish Harami pattern, bullish Harami pattern, sorry, whereby, again, you have that very, very negative, long negative candlestick followed by a shorter positive one. And again, just suggests this area here. Let me just grab, just grab this here. This level here, this kind of 156.80 to 90 zone, very, very strong support. Now, we have had a much better than expected PMI reading, which has really helped push the pound. Obviously, 158 there being short-term support, and then above there you've got this double top here, 158.80. So there's an awful lot of kind of range trading motion to be put in place. Now, with the pound, on Thursday we have got the Bank of England, but no changes expected there, so we don't think that's going to be the big mover. What may be, though, is that our new bank, or the UK's new bank governor, Mark Carney, he's going to come in July, take over from Mervyn King. He's going to be testifying to Parliament on a Thursday. So, you know, if he comes out with a real, you know, dovish sentiments, then we could really see it start. Then we could really see the pound start to suffer, because the pound has become very sensitive to domestic issues. Now, that sounds like a no-brainer, right? But for a long time, the pound was quite ambivalent to what was going on at home, quite ambivalent to QE and what the Bank of England was doing. We believe that relationship has become more important, or that what the Bank of England is doing and the pound, that relationship has become closer. We also think, of course, that the pound is still being moved around by what's been going on with Europe and rising bond yields and stuff. So there's actually a few drivers of the pound now, and it's not just become kind of almost a the safe haven asset it once was. So what we really see, what I'm showing you these two lines here for, is that until we get to that, until we hear from Carney, we could really range trade, as I mentioned, just below 159. So this kind of 158.80 area. It's a really powerful level of resistance. Not only was it the level that we couldn't get above in 2013, but it was also significant back in kind of August as well. But that was on the way up. So we do expect, if we can get above this kind of 158 level, for us to run into resistance around there. Now let's go back to euro really quickly, because I want to just give you some levels there as well. It's better on the... That is obviously the top here, but we would say that double bottom there, so just below 136, could really act as a bit of a buffer zone where we run in, where it might attract some short-term selling interest. Now, it's very difficult, I think, actually, to trade the ECB meeting itself. Now, the ECB meeting is so important because it's the central banks are usually very well scripted. Now, the ECB is particularly good at communication, actually, but they do have this Q&A, which can mean that they sometimes go, how could I say? They can say unscripted things, which can be very powerful for the market. The other reason why it's important, of course, is because it was the ECB that said, as I mentioned at the start, we're going to save the Eurozone. So that does become really important. So what we could see here is that we range trade into it. range trade into the ECB meeting. We then have volatility, and it can literally be like whipsaw volatility, whereby we can easily move like 100 pips or whatever a day, but we don't necessarily think. But I don't know. That's quite a difficult trading strategy to have, and to trade the news can be quite difficult. Rather, looking at these patterns, looking at the charts here, you know, I would probably say that, hang on a minute, if we get back kind of below that kind of 134. 60 level on the back of the ECB meeting. These to me are my ranges. This is what I'm looking at. I think this here is now a big buy zone around about kind of 130 foot, just ahead of 134.50. I would also say probably just for the I would also be aware of just below 134.50, so around about that 134.40 level. If we were to get some very dovish sentiment from the ECB, then we could fall down to this level. However, we think the bigger risk is that they're not dovish, that they're actually more hawkish than expected, and that can be the kind of the fuel that pushes us higher. And for that, to really kind of extend gains to 137 and even beyond, so 137.20 and even beyond, we probably need to get above this kind of 135.80 level. But again, you know, we could see some whipsaw action. So I think that the ECB at the moment, they're the only ones in the major central banks who aren't cutting interest rates, who aren't pumping the economy with more stimulus. That may, because they're not doing that, the ECB meeting may just reinforce the more hawkish policy stance compared to other banks. So that can be quite a good way to do it. So euro-dollar, looking at euro-dollar, that's going to be the most standard. In news events, that can be the best one to trade because it's so liquid. Ahmed has just asked a very interesting question. Is there a price where the market thinks the euro is either expensive or cheap? Well, it depends on your time frame. So if your time frame, for example, is short term, let's look at this. Just say you just looked over the last couple of days. This chart gives you a great example of where the buy and sell zones are. You can see it immediately. In fact, I'm sure that you or some of the other participants could spot it immediately. Below 135, so 134.80, that nice bullish Harami pattern, that suggests to me that there was a big push to get it below 135, and then people came in to buy it. So that to me is a buying zone. However, what we did see here was the exact opposite. 137, people were thinking, hang on a minute, they pushed it up there, all of a sudden they're taking profits. That is the buy zone. So this is the zone that I'm looking at. Again, I think there's a bit of an interim zone in there as well. As we lead up to that ECB meeting, I think buy zone probably 134.60, sell zone on a very, very short-term basis, so these intraday traders, it could be 135.80, and 137.20 for the slightly longer-term traders. Dr. Rob, interesting name, has just said that the average price since 2000 is about 136. Is it? Let me just take a quick look. Oh, my data only goes back to 2000. I would have to look at that more closely. In fact, I'll just take a quick look at 2000. The low has been 85. The top 160. It's hard to. I would say it's slightly below there, actually. This is the very long-term euro chart. I mean, look, we're going right the way back, so it's not perfect at all. But I wouldn't say that since the eurozone's been in place, that 136 has been the average for euro dollar. I just wouldn't say that was the case at all. Okay, let's move on. Let's also look at the Aussie. That's been an interesting mover because you've got to be patient with the Aussie, right? That's going to be the key thing. This is the hourly chart. Let's take a quick look at the daily. As you can see, really, really, really important support zone. The Aussie hasn't really done anything. Now, the Euro's kind of moved higher. The Aussie's been very much trading in its range, and it's now towards the bottom of that range. Now, the RSI really moving sideways, not telling us too much, but we did have the RBA meeting today, and as expected, they kept rates on hold. They did suggest that they were going to cut in future, but we think that the next most important thing for the Aussie dollar is actually going to be some employment data, which will come for January, which will come out on the 7th, so that's also on Thursday. That comes out midnight London time. very early Thursday morning. The market had seen Yas has also mentioned retail sales. Retail sales are important for the Aussie, but the employment really is key. Now, retail sales have been, they kind of reported on a monthly basis, and actually for 4Q as well. So they are going to be important, especially though combined with that employment data. Employment data in the Aussie has a really strong, has a strong correlation, or volatility in the Aussie dollar and employment really has a strong correlation. So what are we looking at when we're looking at the Aussie? Well, we don't know what the employment data is going to come out at. If it's very, very weak, then we could see it get through this 200-day moving average, which is 103.75. If we get below there, that is a very, very important development, or very bearish development for this cross, because it opens the way to the October lows of 101.5. Now, what would protect us? Not the RBA, not even a dovish RBA can get us through that level. Well, I think it's more that the RBA is a very reactive central bank. So the January data, so that's why I actually think that the employment data is slightly more important now than retail sales tomorrow, is because it's more up to date. It's for January as a whole, and as we know with things like payrolls in the US, it can really set the tone, the trading tone. We saw very weak employment data at the start of January, and that really was what pushed us all the way from kind of 106 back down to kind of this 104 level. So it has got a precedent of being really pivotal. So another month of very disappointing data could get us through this 103.80 level. We've really bounced around it. It's proven to be a very, very good support level, so that's a level to watch. If we don't get below there, then we expect us to be range trading. For example, if we got a better than expected retail sales report and employment report, then there's a good support 105 and then 106. So that's the key thing that we're looking at there. Okay. But Aussie has been quite interesting. Another cross to trade is Aussie Kiwi. As you can see, let's go, here. This is at quite extended levels, and it's quite close to a very important support zone at this kind of just above 123. Below here, again, very, very bearish development. So Aussie has been one of the weakest performers, certainly in the commodity space. The Kiwi has done very, very well, largely been propped up by what the RBNZ does. What does that mean? Well, you put the two together and you get weak Aussie Kiwi. Now, this is a weekly chart. Let's go back to that daily chart and you really see how sharp that fall off has been. However, we have seen a bit of some violent reactions as we get to this 123 level. We do think 123 is quite a good buy zone. However, it's going to be a lot to do with that Australian data. The RBNZ, because it surprised on the hawkish side, has meant that the Kiwi side of this relationship, so the New Zealand data, has really been the thing that's led this higher. And then in contrast, what we've seen is what we may see this week is that the Aussie data really does move this cross. So again, if we got below 123, so even down to like a daily close to maybe 122.80, that would be a very, very bearish development, which could open the way back to a move towards 120. But for that to happen, we will need some really bearish, some very bearish Aussie data. Again, if we get a positive surprise, as you can see here, there's some nice support levels. I mean, the first one would probably be 124.30, and then above there, kind of just below 125, around about that 125 level. So kind of do watch out for that. Obviously, this pair tends to be it tends to move sideways when there's big periods of risk aversion, which is like what we've seen yesterday. So saw a bit of a recovery and then kind of sideways moving. But at the moment, it's all about relative central bank stances. That's not really in the Aussie's favour. So it goes down to kind of economic data. And so the market really is poised now to react to that employment data early Thursday morning, and that's going to be very, very important. The other thing I want to show you, of course, is going to be Japanese yen. Bear with me one moment. As you can see with the Japanese yen here, this is dollar yen. Again, we kind of did push higher Oh, let's go to the daily chart. We did push higher all the way to 93.20. Really, really nice double top there. Looks like a tweet's top. That's now significant. That's your short-term top in place. And then obviously again, it's still kind of trading this range. 92 very, very well supported on the upside. On the downside, very, very well supported above 92. So I think, that to me does just kind of maybe just trading a little bit sideways. We have got that is a manufacturing data today, but as is normal, after payrolls, you do tend to get a quiet data week. So, what are the things on the horizon to look out for? Well, today we did have the Bank of Japan governor announce when he's stepping down. That's going to be the 19th of March. A lot may come out politically and politically from Japan about who the next governor will be. There's big expectations that they're going to choose a very, very dovish guy. That is going to be significant, of course, because if the government put in place a very dovish Bank of Japan governor, then it could extend this yen move lower, because people would then expect that he'll do all he can to help the government out in this growth problem, and also and just continue to weaken the yen. So do watch out for that. The government and the Bank of Japan have been very, very powerful in moving the yen of late. Now, one thing I do want to see, some people have been saying, oh goodness, has this euro rally ended? Has the dollar yen rally ended? Has the rally in stocks ended? I would say absolutely not yet. We don't have any evidence of that being the case at all. If you take a look at these move higher since November in dollar yen, there have been periods when we've moved sideways, actually for quite significant lengths of time, like as in a number of weeks. That's what we tend to do. Move forward and then go up. We're going up into steps, and you can see it. Now this has been quite a step. So this is a step higher, move sideways, big step higher, kind of bit of a move sideways action, a bit choppy action then in the first couple of weeks. So this is very, very normal. So I think if some people were worried that was going to be over, that's not the case. Likewise with euro. This is going back all the way back to August. Step higher, move sideways. Step lower even, move higher. That's all. That's going to happen when you're in when you've got a sovereign debt crisis and political issues. Gem Trader has said a very good point. It can be quite difficult to get in. Stops quite far. Well, yes and no. I'm not sure I fully agree with that, because I actually think these pullbacks are really, really useful. I'm going to show you a really interesting chart here as well. Sorry, Dr. Rob has just sent me a note. Okay, fine, yeah. I mean, since 2004, I'd say that 136 in euro dollar probably has been the average. Again, I haven't quite done the calculation. I also haven't read the article you mentioned. But things do tend to go above their average. But as you can see, the trouble is when you look at long-term averages, it doesn't really help you if you're a shorter-term trader. A good way of thinking about it is that we still think the euro will push higher and potentially could go to 140. But we equally think that it could drop back to 125 in the kind of coming months. Right now, we still think the bulls kind of have control, and that we know that there's some resting interest. But the one thing I am looking at, those who were at the FX conference in London on Thursday will know, being a good trader is actually about, a good retail trader anyway, is finding out, what's the current market sentiment, and it's good to know kind of who's in where, what are they thinking about. Well, what we did see last week was we've seen some positive inflows into euro. But we did see that slow quite sharply last week. So I'm going to look at that very, very closely, because I think some people will be a bit concerned, which could limit euro upside, and again make it very vulnerable to sovereign issues. But at the moment, we do still think we think that there could be, only if the sovereign backdrop remains stable and the ECB gives a satisfactory meeting, then we could see us again take that next step higher. But until then, that's probably going to be our sideways movement. So I think that certainly in the short term anyway, picking up the euro on some lows with a tight stop may not be a bad idea. I don't think that we've gone into that mindset yet where people are chucking in the towel on euro already. I just don't believe we are. I think there could be further upside to come, and I think that people will buy it on lows. Someone's just said you buy euro yen or dollar yen. That's really interesting. This is, let's take a quick look at euro yen again, because euro yen's been quite interesting. It's moved on the back of, you know, obviously two things recently. Dr. Rob asked a really good question, and I will answer that in a moment, but let me just stick with euro yen. Euro yen's been an interesting one because it has gone so fast, so high. People saying, well, what should you be in, dollar yen or euro yen? I would probably say dollar yen if you were going the long side of that. And the main reason why I think that is because, number one, it's more widely, well, I mean, they both have great liquidity and they're both very widely traded, but the US doesn't really have that sovereign issue. I think if you are thinking about a long position, then dollar yen could be the thing to get into, largely because euro yen on the long side, it's going to be really hit hard if we get another bout of risk aversion. So that's my fundamental viewpoint. Added to that, I just think that probably at these levels it's looking, you know, euros is looking good, and if we can get above kind of 127.05, then we could easily get to 130. Again, I think, you know, it could be picked up around about that 120. Well, you know, it has been picked up kind of here at 123.75. So once we got below 124, that was the buying interest. So in the short term, you know, there certainly are, people are certainly picking it up on the lows. Again, you know, there's a lot more the attraction of euro yen is that the central banks the relative central bank policy is very euro positive in this relationship, but we are approaching a bit of a potentially a bit of a sell zone. So this 127 level is a massive support resistance zone here, going all the way back to 2010. So we will have to watch that very carefully. Dollar yen, the reason why I would say that is purely because I think at the moment, now that we've got some sovereign concerns in Europe rearing their head again, political concerns, that's your biggest risk for euro yen at the moment, is that they move high. But if we can get above 127, we are at 125.70, sorry, so we're a bit away from it, but this 127 level really has acted as good resistance. So I certainly wouldn't buy here. I would buy possibly on a pullback towards, that's a weekly chart. Let's take a look, maybe a pullback back to this level. So this zone here, maybe for a short term anyway, kind of back to 122.70. This is only if you're a very short term trader, purely because you don't want to get in at the highs, you don't want to be unseated or turfed out of your position at that 127 level. So it's always worth looking at your levels first. Dr. Rob, again, good point. The ECB will allow the euro to, what level will the ECB allow the euro to reach? Well, the ECB shouldn't really intervene at all. That doesn't mean that it hasn't, it doesn't mean that other central banks haven't, but it does tend to be the last one to the party in this currency war game, which does mean that potentially the euro could suffer, and by suffering in the effect this currency war, it means that your currency strengthens, your economy weakens. Traditionally, the Bundesbank hasn't minded having a strong currency. That could be problematic down the line, for sure. Things like, you know, what's going on in euro yen, that's going to have an impact because, you know, Asia is a big, Japan is a big trading partner of Germany's. So I think it's going to be interesting if they mention the currency. I've got a feeling they'll keep away from it. But if they mention it, then we could see, they mention the strength of it, then we would expect to see quite a sharp sell-off in euro, quite a sharp sell-off in euro yen as well. Someone's just said, Stefan has just mentioned, has the euro peaked yet? I'm not 100% sure. We think there could be another push towards 140, but I think that what Dr. Rob has said is that 140 level is a massive resistance level that the world and his wife has been looking at. So levels in dollar yen is what Yasser would like to know. Dollar yen obviously has been interested in, you know, obviously there's been buying interest, as I mentioned, kind of around about that 92 level. So around about kind of below 92.50, this cluster of hourly moving averages has been a really good buying interest, and then selling again at 93.20. And we think really just because there's not, I mean, obviously it depends. If we get very good ISM data later on from the US, that could push us above that 93.20. We do think the momentum is still to the upside in dollar yen. We could still see 100 in 6 months. but we would expect a little bit of a pullback maybe. So 92.50, a very good support level there, and then kind of 92. That's if you're a short-term trader. Obviously, if you're a long-term trader, then you may decide instead of buying on the dip, you may actually wait for a breakout and actually trade that breakout, which would be 93.20. So do watch out for that. I also wanted to lastly just show you the S&P 500. I know some of you trade this. Time just goes so quick. Thank you for all your questions. They've been great. The S&P 500 did close down down below 1500. Again, it doesn't suggest that we've reached the top anytime soon. It's quite powerful. It'll be interesting today if we can make it up just a little bit. Then if we can have a positive day, even just a small positive day rather than another down day, then it would suggest that 1495 is a key level of support, and that is a temporary bottom, and we could again retest this 1520 level. But things that could drive it going forward, obviously, some more. We're coming to the end of earnings season. We know that earnings are quite supportive. 2013 guidance hasn't been fantastic, but we still think that good earnings data combined with some good growth signals for 2013 will be what pushes us above 1520 and maybe towards that 1565 record high. We still think there's a very good possibility of that happening. This is just a very normal pullback, but we will be watching it. It's kind of one day at a time now. You can't, like all this period here where you just saw it move up so strongly, you can't take that type of thing for granted at the moment. People are getting nervous around these big levels, thinking, have we come too far, too fast? But we still know that there's problems with growth and with sovereigns, and that means that kind of the market is more slow, it's more quick to take profit, so you've got to be careful. Someone's just mentioned about EURUSD. I'm just going to mention that now. I think that's always a nice one. Obviously, it didn't move for so long, but EURUSD, as you can see, again, it picked up a bit at 122.60, so just ahead of 122.5, and has been moving higher. I mean, still the high is that 125 level. Take a quick look at its daily. Very, very, very choppy, but this looks like a bit of a double bottom to me at kind of 122.60. I think that's a temporary bottom. I would look potentially for a bit more of a recovery here, but again, for EURUSD, it's always going to be the most supportive, especially now that it's started to move again. Now the floor is still in place, so you've still got that 120 low. Possibly the 120 floor may go up. I'm not 100% sure it will actually, Dr. Rowe. I think that there's a good chance that they won't. It's very expensive to hold this floor, and as long as things remain stable in the Eurozone, I really don't think they will. If we see a massive blowout in Spain, for example, then the S&P may act. But for now, we think that they're probably going to remain on hold and hope that the Spanish hang on. So again, 122.60 looks like a temporary double bottom. 124 is your natural resistance there. So again, a bit of range trading. And someone said watching dollar index as a directional sentiment indicator. I do indeed. We actually have started offering it, so you can trade it on the forex.com, with forex.com as well. Just bear with me here one moment. I'll just show you what's been really interesting about the dollar index has actually been the fact that it has not, even though dollar yen has done very well, the dollar on a whole hasn't really. But it has shown that, that 79 there is a nice bottom, that there's buying interest up there. We are running into resistance, 79.84 and then 79. So again, like, the strength overall in the dollar index the last couple of days has been reflected in weaker commodities. So do watch that. But funnily enough, not in weaker gold. So again, that just is another reflection that yesterday very much a risk-off day. The dollar index as a whole has been moving a bit. Is going to be impacted by what's going on in Spain. So in that sense, do watch out for that. And again, it's the ECB meeting this week that's going to be key. The Bank of England governor, upcoming governor, what he has to say as well. They're going to be key drivers of European currencies this week, so do watch out. Now, half an hour goes so quickly, but thank you all so much for joining. Good luck with your trading this week. Please do join us maybe for our other webinars. You can register for them on our website. For the ECB one on Thursday. I've also got another one tomorrow, and please do keep up with us. Look at what we're doing on Twitter at forex.com if you are on Twitter, and good luck with everything this week. So thank you so much, and hopefully you can join me next week if not before.